So let's talk about financing. When I got involved with B2R in September, I told the chairman of the company, who is also the chairman of Invitation Homes, the Blackstone company that bought 43,000 houses, I told him that what investors needed was a consistent, dependable financing source that allowed scale. Because when you look at Fannie and Freddie, now look, no one's ever going to beat their rates because it's stolen government money and they can loan it out for 4% or whatever. So take all of it you can get, right? I mean, just take all of it you can get. But at the end of the day, they penalize you for scale. The moment you get where you're almost a great borrower, they say, whoa, we can't give you any more money. It's probably the most counterintuitive thing the government actually does. Because if you have 5 houses and one goes vacant, what's your vacancy factor? 20%. Great. If you have 10 houses, one goes vacant, what's your vacancy factor? 10%. If you have 20, one goes vacant, 5%. It's much more manageable to be scaled in this business. Community banks, one of my problems with community banks is you can almost always get a better deal at community banks than you can with a large national lender like myself. But the problem is, raise your hand if you live in California. Okay, so raise your hand if you would want to exercise this strategy outside of the state of California. Okay, so community banks won't touch you until you have a track record, until you have a local presence, until you may be able to meet someone like a Brian Scrone that could walk you into a local bank that he had a long track record with, but that's not scalable. You can't build your strategy based off of if and when you meet the right person. And then you have hard money lenders. Hard money is a great way to buy distressed property and stabilize it. It is not a great way to generate yields. And too many people, we've got a guy right now we're doing a $1.2 million loan with that he's been in 14% hard money for 2 years. Hard money lender loves him. I mean, that hard money lender, he's like 50% LTV in these houses. I mean, the hard money lender is going to keep renewing him as often as he'll write the checks. But it's not good for you as the investor for a yield. So let's talk about net cash flow. Gross potential rent. Less vacancy, right? Because houses go vacant. The National Association of Realtors say that the average rent house goes vacant every 1.8 years. So you're going to have vacancy on your property. Maintenance. I've never met a tenant that took care of a house. Just the bottom line. You know, I had this tenant a couple months ago call me and they wanted new carpet. They'd been in the house for 4 years and they were willing to renew another 2-year lease. And I said, well, Jennifer, that's great, but why would I put new carpet in that house? It's only 4 years old. She goes, well, that's normal wear and tear. I said, no, sweetie. The house I live in, I've been there for 5 years and I got a 4-year-old and a 13-year-old and I don't need new carpet. So that's not normal wear and tear, but you're going to have those things. Operating expenses, property tax, insurance, property management. If you're not a professional property manager, do not try to manage your own properties. You will fail miserably, and when you really model in the yield, your yield will be higher by having someone that was competent, collected on time, collected fees, and made sure that your rents were increased when they needed to be or that you had better retention whenever a market may be getting loose. I use property management on my entire portfolio. And the same thing with that goes with anything, right? If you're not a professional general contractor, don't try to fix the houses yourself. I know it's fun to go to Home Depot and buy the toilet paper holders and go put them in on the weekend, but you're not good at it. I mean, unless your time is worth $10 an hour. If your time is worth $10 an hour, then you should put your own toilet paper holders in. But I doubt many of you are sitting in this room right now because you make $10 an hour. If you are, well, then you should probably do your own construction. Then you have capital expenditures. Well, that gets you to your underwritten net operating income. Then you have capital expenditures. Capital expenditures, roofs, central heat and air. The capital expenditures are, we estimate on average, it's about $450 a year if the property was in good condition when you bought it. And that's money that you may not spend it every year. But after 5 years, you're going to have spent about $500 a year just on capital expenditures. A new roof, a new central heat and air unit, a plumbing system issue, just something that houses have problems. And you need to, and we count that in. And then you get to your underwritten net cash flow. And that's the absolute most important thing. Because even if you're just looking at investing with cash and cash alone, you can actually make decent returns using this formula. The beautiful thing about leverage is it allows you to spread your risk across multiple sites. And that's where you get into scale, and that's where you don't become okay, who's ever heard the example of the tenant that calls at midnight with the toilet? Right? Now raise your hand if you actually own your own property and you've ever had a tenant call you at midnight with a toilet problem. People don't clog up the toilet. Yeah, but you've done too many, Brian. You're the property manager too. People don't clog up a toilet at midnight and call you. They wait until 8 or 9 in the morning and say, oh, my kid dropped a toy in there. Unless you're renting to college kids, and then that's just a whole different model. They're kind of proud when they clog up the toilet at midnight, right? So I want to talk about different limitations. So GSEs, the Fannie, Freddie, LE loans, they're going to cap you at 4 to 10, and it's really hard to meet someone that's actually qualified for 10 mortgages. Unless they just really have a smoking hot loan officer, and I don't mean like visually, I mean really good at what they do. It's hard to get to 10. I mean, if you got $1 million in the bank and an 820 FICO and you make $1 million a year, you can probably get there. Commercial style loans, there's no limit to the number of properties. Like from that's going to be lender dependent. It's a lot of lenders have like small community banks in Texas. They have loan limits versus property limits. And once they get to say $2 million, they're not allowed to give any one borrower more than a certain amount of money, and then you got to go find another bank, then you got to go find another bank, then you got to go find another bank, or you got to get 2 banks to work together, and it's difficult to scale. Loan structure. I feel like the GSEs are way behind on this, because who's ever closed on a Fannie or Freddie mortgage? Who's ever closed on a non-owner occupied Fannie or Freddie mortgage? Here's the fun thing about those. The loan docs are almost identical to like an FHA mortgage, but then there's an addendum on the back that says you may, notwithstanding the foregoing, you may rent the property out. It's pretty simple. These loans are going to be multiple properties per loan, and most likely they're going to be cross-collateralized. The thing that I love about that is then as a borrower, as an operator of a business, I really only have one check to write every month. I really only have one amortization schedule to keep up with. I really only have one interest calculation and tabulation for the year to keep up with. Borrower. Another counterintuitive thing that Fannie and Freddie do that I just find ridiculous is they tell you, yeah, we'll let you buy rental property, but you have to do it in your own personal name. So liability-wise, it's ridiculous. Whereas a commercial lender like myself, we're going to make you put it in a corporate entity. I do not loan money to individuals. I only loan money to corporate entities. And because if you own rental property and they're not in a corporate entity, I mean, just be careful. Underwriting. These are heavily underwritten on your own debt to income ratio, whereas a commercial mortgage on rental property is going to be underwritten on what's called the debt service coverage ratio. You'll see this term more and more and more. The DSCR is nothing more than the debt to income of the property. So if you're asking for a $1,000 a month mortgage payment from me, I'm going to make sure that the property's underwritten net cash flow from the previous slide is at least $1,200. I'm going to look at your financials last. I mean, because at the end of the day, if you're a good operator, which if you have 5 or more houses, the assumption is you can be a good operator, it's more important to me that the properties can pay me back than you can pay me back with your doctor job or your lawyer job or your whatever you do for a living job or your pension if you're retired. Because to me, if you get in trouble, I can step in, use what's called an assignment of rents provision. If you're fairly new and you don't have the experience, we're going to require you to get a property manager. And then I can call your property manager and say, hey, I'm not going to pick on Jose, but I just saw your name first. Jose got a little behind, Jason. Here's the form. You're going to need to start sending the surplus cash flow to me. And then we're going to erase any indebtedness to us. We're going to pay your monthly bills for you and send you what's left. It's called cash management. It's never in place until you get behind or there's an event of default. The beautiful thing for me is that keeps me from ever having to foreclose on you. Unless you go commit fraud and willfully, act in a bad manner, I can place cash management, collect the funds, and it's called a waterfall, and you get what's left. Ideally, we never get to that point, but it's one thing that I actually like as a lender because it allows me to kind of step in for a couple months and help you manage your portfolio if you get a little behind. Cash out financing. It's a little crazy there. With us, we don't care about cash out. But here's the way it works, and I'll go ahead and cover this. In the first 90 days, we're not going to let you pull cash out above your basis. It's actually a 75% loan to cost in the first 90 days of owning it. Because at the end of the day, even if you get the smoking hot deal like we at HomeVestors do all the time, I don't think it's a solid business philosophy to be operating and planning around borrowed money. So the first 90 days, it's a 75% loan to cost. We count your purchase and your rehab into your cost basis and your closing cost from when you purchased it. From day 91 through day 365, it's 90% loan to cost. So really and truly, for the first year, we want you to have at least 10% skin in the game. We know that that's going to really lower our default risk. Because what we don't want to do is what Bloomberg says we're doing. We do not want to create subprime 2.0. We do not want to start, stated income, stated assets, we'll give you 75% cash out. You don't have to have any money in the game. After day 366, you can pull out as much cash as you would like, up to 75% loan to value. And that's because we figure if you've operated the asset for 12 months, there's a lot less risk in that by letting you reap some profit. Pricing. I think what are the GSEs pricing out right now on NOOs? 5%? 4.6 to 5, yeah. That's inching up. Right now, our pricing's around 5.5 to 6. It depends on the LTV you're asking for. We have priced out a couple deals recently around 6.5, but those were a little bit more risky portfolios. High crime rates, high vacancy rates, things that we felt like needed to be priced into the deal. But for now, of course, the government money has the advantage there. And then minimum properties, I think they have the advantage there. They can do one by one. With us, you have to have at least 5 houses. Because, again, it's about operating risk. I know that you're going to be a much more solid borrower if you have 5 houses to spread your risk across instead of just one. If you have one and it goes vacant, it's pretty easy to figure out that vacancy factor.